And I'd like to introduce our roundtable participants. You know them well, starting with Ben Moreland, who is the president and CEO of Crown Castle. We have Brenden Cavanagh, the executive vice president and chief financial officer of SBA Communications. And last but not least, Rod Smith, who is the Senior Vice President and Chief Financial Officer of American Tower's U.S. Tower Division. Well, good morning, gentlemen.
Good morning, John.
We were talking backstage, it's a good year for the industry. There's been some consolidation, of course, in the last year. And Ben, how's your integration of AT&T towers going? And Rod, maybe you can talk about your integration of GTP.
Well, I'll start with that. First, I want to congratulate you and the staff on pulling this show together 7 months after the prior one, 6 to 7 months. It seemed like a tough task, but the turnout this morning is fantastic and speaks a lot about our industry and what's going on right now. So, to the business at hand, we're up to our years in integration right now, to be very clear. We're in the middle of integrating 9,700 sites we acquired from AT&T at the end of last year. We're about halfway through, depending on who you ask in the company. And for those of you that have gone through similar things, and I know these guys certainly have, it's a process, but you work through it. It's usually about a 6 to 9 month process before those sites are fully integrated and able to take applications at the same speed and pace that we're used to in our company. But so far so good, and very pleased with how it's going, and frankly the support we're getting from AT&T. It's been very helpful.
Good morning, Jonathan, and it's great to be here, so thanks for having me. So we closed on our acquisition of Global Tower Partners in the fall, and really the fourth quarter of 2013, and we're substantially complete with the integration at this point, so it's gone extremely well, extremely smooth, and at this point we're ahead in terms of capturing our SG&A synergies that we originally had in our investment case. That certainly provides a lot of tailwind for us going forward in terms of margin expansion and those kind of things. And we also posted very strong growth on those assets in Q1 of 2014. So the core organic growth for the GTP assets that we acquired was 9.9% for Q1. That outpaces the core organic growth of the legacy 8 American Tower sites, which was 9.2%. And both of those numbers are really strong growth, well ahead of the 6 to 8% core organic growth range that we target long term. So we're very pleased with that, and we believe that the really strong growth in the GTP assets is a result of the high quality locations of these assets, the fact that these assets, when we acquired them, had on average 2 tenants versus the 2.5 tenants that we have on our legacy sites, and that facilitates very quick and easy co-location with minimal capex, and it really helps with that co-location process. So we couldn't be happier.
Fantastic. Well, it's been a good year for the industry. As we said, it makes it easier for a trade association head when it's a good year for all of you and for everybody in the room. But let's discuss what's driving it. Obviously, 4G is driving a lot of revenue, driving a lot of growth. And a big question that I hear from a lot of people is that sustainable? Is that something that's going to last? Where are we in the rollout of 4G? Or you look at the coverage maps and companies say, well, the big 2 carriers show that they're completing their initial 4G rollout. But are we really in full swing here? Are we almost done? Where are we on the 4G rollout?
Well, maybe I'll jump in. First, before I get to that, I just want to mention Jeff Stoops, who's SBA's CEO, who really wanted to be here today. I look forward to meeting with many of you. He's recovering from some minor surgery, doing very well. Unfortunately, couldn't be here, but I'm very appreciative of the opportunity to come up and talk with you a little bit about SBA and the industry today. So back to the question. At SBA we feel like, and I'm sure all these guys would agree, that there's still a long way to go in terms of the 4G deployments. While we've seen record growth over the last couple of years from all of our big 4 carrier customers here in the U.S., based on the backlogs that we have today, which continue to remain at record levels, I think that the growth trajectory in terms of continued deployment is significant as we look into the next few years. So when you look at what's happened, a lot of the amendments that we've been signing have been for 4G upgrades. There's still a tremendous amount of that going on. There's still a lot of coverage build being done as well, as carriers still have a lot of areas where those of us that travel a lot know they still have coverage objectives to meet. So we would expect to continue to see growth for the next several years at levels that are similar to what we've seen over the last couple of years.
Our investment thesis, around our business really is focused on the U.S. market, and we, over the last 2 years, have invested around $9 billion in adding infrastructure in the U.S. That's the two largest carrier transactions. We acquired the carrier towers from first T-Mobile and then AT&T, as well as a sizable business in the small cell arena, NextG. Our entire investment thesis is based on we have a long way to go. I've actually been in this industry 15 years. I think we're going to have a record application volume this year. I would suspect you guys will as well. Probably never seen it as busy as we've seen it right now. And it's really playing out the way we had expected through our experience. As Brenden allowed, you have a lot of amendments going on, continuing the build out of the original 4G deployments, depending upon which carrier and which market. And at the same time, we're seeing significant co-location activity return to the market, primarily with the industry leaders first, as their networks are the most loaded, with 4G being in the market the longest, where they're adding capacity and coverage where they didn't previously have it and where they now need it based on the usage of the 4G networks. And we think that's going to continue right through Sprint and T-Mobile over time. So, one of the premises for our industry that is very compelling to the carriers and to Wall Street is that it's a very efficient way to get networks built and deployed. It's cost of capital efficient, essentially the sharing of the infrastructure model that is so important. And we've proven that over time in a very resilient way through up and down business cycles where the industry continued to grow and meet Wall Street expectations, notwithstanding some pretty difficult times in the financial markets that occurred, certainly 4 or 5 years ago.
Yeah, Jonathan, the only thing I would add to what Brenden and Ben has said is that American Tower is also bullish on the U.S. wireless marketplace. We've, in the last several years, have invested over $7 billion in U.S. infrastructure. We also have assets on 4 other continents in 12 different countries. But 64% or so of our acquisition capital has been spent right here in the U.S. over the last several years. So we absolutely are bullish on the U.S. marketplace. And in terms of the LTE rollouts, we see Verizon has completed their initial rollout of LTE. So their network now, is the way we describe it, is kind of a mile wide and an inch deep. So they're going to have to come back in and densify that network for sure. They today cover about 300 million pops, which is really good for the U.S. AT&T is also rapidly moving through that initial LTE upgrade, and they're approaching 300 million pops covered as well, and probably would get there sometime this summer. And then we see Sprint and T-Mobile actively working on upgrading their networks to LTE as well. They're a little behind Verizon and AT&T, but towards the end of the year, they may have 225, 250 million covered pops. So it's been a long time since we've seen all 4 wireless carriers as active as they are today. And from our point of view, we believe that'll continue for a lot of those demand-driven reasons that you talked about in your opening remarks, which I think we'll talk about a little bit this morning as well. So it's a great time in the U.S. wireless space.
They've been really active, and it's moved really fast. 4G's moved at lightning speed, and wireless siting policy is something that we work on a lot at PCIA, and I'm curious, more states are passing streamlined siting laws. We are working to craft rules with the FCC, and the FCC's taken action, as you heard from the chairman. They're supporting us every step of the way. The Supreme Court's about to weigh in on a circuit split on a requirement for a written application. And we're really seeing and sensing a change among policymakers about wireless. So they seem to want it more. They understand that they need to help facilitate this. Are you seeing that shift on the ground? And is it affecting your business, how 6409 has helped with co-locations? And are you still seeing some big obstacles, some regulatory obstacles? What are some of the big obstacles remaining despite some of the progress that you might be seeing?
Well, we definitely are sensing a shift, and I think a lot of the credit for that goes to PCIA, who's done a tremendous amount of work in helping the federal government to understand what we do and how it contributes to wireless growth in general. So kudos to you, Jonathan. at the ground level, as you mentioned, a lot of states have adopted co-location by right laws. We're now starting to see that happen, obviously, at the federal level as well. There definitely seems to be a shift at the FCC, the federal government level, to appreciating what what infrastructure does, and helping to do things to try and speed along the process of getting that wireless infrastructure deployed throughout the country. So, from that standpoint, it's definitely eased, and we can sense that at the ground level. Having said that, there's always things where you have some, you have things happening that seem to fly in the face of that, whether it's rules adopted regarding public notice for migratory birds and the impact on those that seem to be the opposite of the overall theme. But having said that, there's definitely a positive shift, and I think the more that companies like ours and the industry association is able to continue to speak to people, meet with appropriate people within the government, the more we're going to start to see that change continue to shift in the direction that it's going.
I would certainly second that. I think generally there's been a recognition of the value that our infrastructure brings to the consumer, to the economy, particularly the shared infrastructure that we bring. And so 6409, led by PCIA, has been a very big benefit in our business, adding speed to the co-location process. And beyond that, while the wind may be at our back philosophically, I think there's always going to be challenges to additional infrastructure, just as there is with any incremental infrastructure that gets added to a community. And that's probably proper at some level. There needs to be healthy debate about what's in the public interest. But in general, I'd say the recognition of what we do and the value of the infrastructure we provide is significant. And when your comment this morning, when almost 3/4 of 911 calls are made on wireless networks, things like that resonate with the public, particularly when they can look in their pocket and find their smartphone and how reliant everyone is on it. It doesn't happen by accident. Obviously, it's everybody in this room and on the stage.
Yeah, I think, kind of in summary, I think the regulations around co-locating on existing towers and building new towers is far from perfect. But as Ben and Brenden said, we do see a shift, really for the first time on the U.S. government's part, where they recognize the value of bringing broadband services to people across the country. And they are trying to make it easier for us to do that. So that's a recognition that is clear and present. It'll take time for them to really work through some of the issues that we see in that siting process. But we have teams across the country that go jurisdiction by jurisdiction to try to get these things done. And it is challenging. One of the things that exasperates that issue is the volume and the demand that we see now for new co-locations and new towers. It really is dramatically increased over the last several years. So the big wireless carriers, the big tower companies, we have the resources to upgrade our infrastructure to deal with that. The government agencies really don't. So they're being flooded with additional applications, and that can slow the process down a little bit. But beyond that, we don't see any significant hurdles. Another example that just kind of highlights how some of these regulations are outdated is that we're required every quarter to climb the tower and inspect lighting kits. And that's been in place for more than a decade. We have very sophisticated network management systems that have cameras up there that we can see and monitor everything we need to without climbing that tower. But yet there still is a regulation that we have to climb the tower every quarter. We go in and try to get that waived and try to get around that, but it would be nice to see the regulations get upgraded to match what's actually happening in the industry today.
That's a great point. We're working with the FAA on that. It's a whole new agency for us. We're really focused on it. We'll try to do the best we can because those are outdated, clearly. Let's talk about the next business opportunities you see ahead. Obviously, this business is about adding more tenants. And where is that next big tenant possibly going to come from? Is there another big carrier coming down the pike? We had Charlie Ergen here at the show in 2012 saying he was ready to build. He bought a bunch of spectrum in the H block. Of course, where do you see Dish? And of course, FirstNet is off to a start. You can debate how fast of a start it's off to. But will FirstNet at some point get up and running? You see some revenue opportunities there and some opportunities to help get public safety the service that they need.
I think what's been clear, really since the industry began, is that there's always parties on the outside who own spectrum or have a product that they ultimately want to launch on a wireless network. And I think that's always going to be true. And so today we have the 4 big wireless carriers. Depending on which day you read the newspaper, we potentially may have further consolidation. But my view, and what's borne out in history, is that there's always new entrants who seek access to the consumer on a wireless device. And with the innovation happening at the device level, I think there's really no end in sight for that. And so as you rightly point out, there's two spectrum blocks out there, one residing with FirstNet and the other with Dish, that today look like opportunities in the future, not yet determined when or how exactly that manifests itself. But I'm very confident that over time that spectrum will get deployed in some shape or form that will result in further sharing of our infrastructure and making that network available to consumers or first responders, depending upon how it goes. And I think we're going to see that for the foreseeable future.
Not to be too repetitive with Ben, but I think we would fall in the same camp, which is ultimately that spectrum will be deployed in one way or another, which will be a good thing for our industry, as it will almost definitely require additional infrastructure in order to deploy it. The question of how that happens and in whose hands it is when it happens, I think still remains up in the air to some degree. So the relative impact on our industry as well remains up in the air as a result. So, we're going to keep a close eye on it. Right now, the significant opportunity that I think is out there remains with the existing 4 big carriers here in the U.S., because that's where all the activity is. As Rod mentioned, this is a time period where they're as busy as they have ever been, which means that we're seeing growth opportunities today that we didn't even see years ago. So I think for the near term, we'll continue to see significant growth from the existing pool of carriers. And it's nice to know that there are other guys out there with additional swaths of spectrum that will ultimately deploy, whether it's in partnership with an existing carrier or independently, that will help sustain the growth rate, I think, for years to come.
I think one thing that I would highlight is that when the industry upgraded the networks to 3G, they didn't have the handsets to use all the capabilities of those networks. So there was a pause in between the 3G rollouts and the 4G rollouts. Today's day and age, the handsets are there for the LTE, so there is no pause. Now that they've increased the capacity of the network up to LTE, we really don't see any pause in terms of them needing to densify the networks, because the handsets that are out there that can utilize the full capability of the networks, they're readily available now. So we've seen penetration for LTE devices go from the end of 2013 from about 26% or so. By the end of this year, we think that'll be up in the mid-30s. So more and more people are getting these smartphones in their hands, and that's going to test the LTE networks and really put a strain on them. And then in addition to that, the things that they do with these handsets is expanding as well. Back to your opening comments in terms of the growth in data demand in the U.S., we think from the Cisco report, it's going to be a CAGR of about 50% over the next 5 years. So we see a dramatic increase in the penetration of smartphones, as well as, and that's driving, what they do with them is driving the dramatic increase in demand. So for us, and this echoes what Ben had said, we think those are the demand drivers that are important to our business. It's not necessarily the number of carriers that are up there, but it's the demand on those networks and the number of customers that those networks have to support. So we are definitely bullish there. And in terms of what Dish may do, we're agnostic whether they partner with a carrier, they try to build out on their own, because we think the underlying demand drivers are there to utilize that spectrum either way. The other thing I would add with public service network, we do believe that there will be a public service network at some point. We don't think it's a this year issue. We don't have anything in our guidance in terms of revenue or cash flow growth, but we do think it'll happen. Into next year it may begin, but it'll be the latter half of this decade that we really see that come through. And that network could come out in 2 ways. It could be the government partnering with the existing carriers, or they could build their own network. And either way, we're here to support that initiative.
The federal government's recognizing that incredible demand and trying to allocate new spectrum desperately to meet it. And obviously, infrastructure is, in the short term, one of the big solutions. I like to joke, you're in trouble when infrastructure is your short-term solution. Spectrum takes even longer, much longer, in fact, and the federal government's efforts are on getting the spectrum from the broadcasters back in, the so-called incentive auction. How do you see those spectrum auctions and AWS-3 sort of impacting wireless infrastructure in the coming years, and what does the shift in spectrum from broadcasters to wireless companies mean for those respective infrastructure types?
Well, I think you can you can continue to see the value of spectrum because the discussion around potentially limiting access to the spectrum auctions, depending upon which carrier you are, certainly drew some response, some very swift response. So the spectrum is obviously still very valuable. I think it'll be in high demand, and again, it's so that you can efficiently add capacity to your network and provide more to the consumer that we're all consuming, whether it be video or whatever you happen to be doing. But video, as we know, is taking up a very significant amount of the incremental bandwidth that's out there today. So we look at it as continued spectrum as it continues to be sold and auctioned and then ultimately deployed drives additional value and utilization of our infrastructure. That's been the way it has been over time. It typically comes with additional equipment on the sites, which gives rise to amendment, additional rent charges for that, as well as infill locations depending upon the frequency and the propagation characteristics and what they need to do in terms of to match their coverage and capacity in a particular market. So we look at it as more of the same and really applaud the administration's efforts to make more creative approaches to spectrum availability come to fruition.
Ultimately, the shift in spectrum from entities like broadcasters to wireless is obviously very positive for us. I think it's interesting when you look back at the early days of this industry, the fact that spectrum was and is such a limited resource helped to drive the tower business, the infrastructure business significantly, because really there were only two possible ways to deploy wireless services, whether that was through spectrum or if you didn't have enough spectrum, you needed more antennas and more equipment in order to do that. So it was obviously a boon for the industry, particularly in the early days. But what we've seen happen here as additional bands of spectrum have become available and fallen into the hands of the wireless carriers in particular is that technology is required that with each new wave of spectrum deployment that it's required additional equipment and additional infrastructure in order to actually deploy that and facilitate the expansion of those networks and the advancement of those new technologies. So we're in a very good position in that the additional spectrum that's being handed out or auctioned off will ultimately continue to drive additional growth for our industry.
And for us, I think American Tower is uniquely positioned in terms of thinking about this issue because we are the largest independent broadcast tower owner in the U.S. and we just further increased our position there with our Richland acquisition in the first quarter of 2014, where we bought 60 additional big broadcast center towers. But I agree with Brenden and Ben that taking spectrum from the broadcast industry and moving it into the wireless industry, we view that as a net positive for us, for sure, and for the industry. On the broadcast side, that spectrum was either not being used or underutilized, so we don't see any incremental churn on the broadcast side. I think that industry would be fine. And whenever you get underutilized or unutilized spectrum in the hands of the wireless carriers, that increases their capex as they go to deploy that spectrum, and that drives amendments to our tower site. So we think it's a net positive for sure.
We can't do it with not touch on small cells and DAS as well. I mean, what do you see in terms of the trends there? What communities now are starting to ask for them by name? They're looking for those kind of solutions. To what degree can a neutral host model work for small cells, and are they really contributing much to the bottom line compared to, I mean, obviously macros are the bulk of the revenue. Do you see this as growing very quickly and big growth area going forward? And how do you address the small versus macro debate at the local level?
Well, John, we're in the small cell and distributed antenna system business in a very large way. We have about 12,000 nodes on the air today, fed by over 6,000 miles of urban fiber. We're very bullish on the business. The growth that we're seeing is very significant. It reminds us a lot of the days early in the tower business of building towers, where we used to do them by the 1,000 instead of the 100, and we're seeing that today. Very much in our business, in our view, and what we're seeing is it is a neutral host model. The shareable element is the fiber, and so whether or not the electronics are actually on the same pole or the next pole over in an outdoor setting, or whether it's in an arena, I think everybody understands that certainly you want all the carriers active in that market or in that venue. And it really depends upon where each individual carrier is in their deployment phase and their architecture. But our view is over time, it's a complementary architecture. It certainly doesn't replace macro sites, but it's in many cases really the only way to get the additional capacity that you need, whether you're in an indoor venue or a very high density urban environment or residential area, where the macro tower site that was sited 10 or 15, 20 years ago is always going to be there, but today is just woefully insufficient to cover the capacity needs of the consumer in those areas. So we're very bullish on it. It's today about 6% of our company and growing very rapidly.
We agree that small cells are definitely for real. I would echo what Ben said about them being complementary to macro sites, which has been our view. The thing about small cells is that they are, in fact, small. They have a very targeted or precise coverage objective, and as a result, where they need to be is very specific in terms of being an effective deployment. I think what we will have seen and will continue to see is the deployment of small cells underneath the existing and growing macro layer of network. And we have an investment today in Extenet, who's started to see some significant growth in the deployment of their DAS networks. So we're starting to see some real movement with regard to small cells. And one of the best things that we've seen as tower owners is that we're starting to see some of the existing wireless carriers come back to us and look to deploy small cells on existing macro towers at much lower levels. And so as we're starting to see that begin to happen, it's an opportunity for existing assets that we own today to use space and locations that were otherwise thought to be unusable in the past because they were at much lower heights and take up significantly less capacity, obviously, on the tower, and to be able to monetize a resource that we didn't think we would be able to in the past. So I think it's a very positive thing for the industry as a whole, and we're looking forward to the opportunities that it will bring in the future.
Yeah, and I agree. I think that the small cells and the DAS are certainly complementary to the macro towers, which is our core business, of course. American Tower does participate in the DAS networks, and I kind of separate DAS networks from small cells. I think they really could be spoken about as different product lines. In terms of the DAS participation that we see, we are the leader in the in-building environment for DAS. That's building out things like the Las Vegas casinos, big Daytona 500 racetracks, other sporting venues. So we see a lot of activity there, and we're investing a lot in that space. And we see the main four carriers, and at this point primarily AT&T and Verizon, really aggressively go after in-building DAS locations. You guys may have seen some recent TV commercials where they show the techs of the wireless companies installing in-building DAS networks. So we think that they have a serious approach to that. We're supporting them that way, and we're further cementing our leadership position with that indoor DAS play. We also have some outdoor DAS networks. We haven't seen a lot of activity. Those networks that we have outdoor average now about 1.5 tenants. A lot of them have been in place for multiple years. Our in-building networks average about 2.5 tenants, so they seem to lease up much quicker. When you get into a desirable venue, the other carriers come along and they want to get in a little bit quicker than what we've seen on our outdoor network. So that's the way we kind of view DAS. We think DAS is complementary. It certainly has its place in the wireless networks. We favor in-building as opposed to the outdoor piece. When it comes to true small cells, I think the wireless industry itself is still trying to figure out exactly what that means, and we'll figure that out along with the carriers. But when it comes to small cells, there's no doubt in our minds that small cells will play a part in the wireless carrier networks in the future. We do believe it'll be in the core urban areas where the population density is greatest, and those are the areas in particular that don't compete with macro sites. So we don't see small cells as any kind of a competitive threat to macro sites, which I think Ben and Brenden have said as well. But we definitely see it as complementary to the macro sites. When you look at our revenue, I think you had said it, Jonathan, that the primary revenue for the tower companies is on the towers. 98% of our revenue comes from towers. We think that's the place where all of our growth is going to come from in the future. And we'll participate in the DAS networks, but we don't think it'll become a material part of our business at any point soon.
Turning to the rest of the world, this is an increasingly global business. Of course, we're seeing more of that here at PCIA shows this year with the Tower Exchange co-locating in Latin America, starting a European association. How do each of you evaluate it? Each of you do it differently, international opportunities, and what do you look at in terms of incremental investment in the US versus overseas? And where do you see the biggest opportunities going forward? And finally, how the capital markets influencing what decisions you're making in that front?
I guess I'll start on that. We look at it with pretty open mind. We look at opportunity cost of capital and where can we best deploy that incremental dollar that we're generating in cash flow to put to work on a risk-adjusted return basis. And while I'll be the first to acknowledge this shared infrastructure model works very, very well all over the world. It's clearly a global platform, there's no question, and we have an international business in Australia. But as we continue to look at opportunities, and as we voted with our checkbook, we continue to see the U.S. market being the #1 growth market on a risk-adjusted return basis. That's where we've made our very significant investments over the last couple of years. So we're going to probably continue to focus on that. To the extent we saw opportunities that made sense to us in overseas markets, we would certainly do that, but that's been primarily a valuation consideration, not a business model, but a valuation consideration for us.
We agree certainly that the U.S. is the best tower market there is, and obviously have the substantial majority of our assets here in the U.S. I think when we sit and think about whether we want to continue to expand internationally, where we want to go, the first thing that comes into play is the fact that there has been a lot of consolidation here in the U.S. I mean, you can see this stage has shrunk over the years. There's less people up here. All three of the companies represented here have gotten much, much bigger. And as a result, the opportunities to move the needle, so to speak, in terms of portfolio growth in the U.S. have become harder to achieve in large part because we're much bigger. So to make that material impact, it takes that much more, and the opportunities are less as a result of having rolled up many of the larger tower companies that existed underneath these three companies here in the U.S. So as a result, we will continue to focus on growth in the U.S., and the organic growth here is tremendous, as we've talked about. But as a way to sort of expand the playing field and increase our realm of opportunities in what we deem to be really the best business in the world, the tower business, we have expanded into other countries and locations. And for SBA, the focus has been on locations that we feel are not too far from home. We're based in South Florida. We have a very large Latin American population down there that we draw upon that helps us in terms of the countries that we have decided to invest in. Primarily to this point, it's been Central America and obviously most recently Brazil. As a result, we have a lot of folks that are local that can help us kind of manage through that. We see tremendous wireless growth opportunities in those countries. We're investing in places where the wireless networks are at least 5, maybe 10 years behind where they are here in the US. And so the opportunity to see that cycle of growth of new technologies, 3G and 4G being rolled out in these markets still lays out in front of us, and I think will continue to supplement and complement the growth that we're seeing here in the US for an extended period of time. And as a result, we've decided to expand into locations where we think the growth prospects are tremendous.
Yeah, so for American Tower, it's probably not new news to anyone in this room, but American Tower is the most aggressive tower investor internationally of the 3 public tower companies. So as I said earlier, we have assets on 5 different continents and 13 different countries. Notwithstanding that, we do believe that the U.S. is the primary market for us, for sure. But we think that there's other places we can invest that complement our investments in the U.S. that will provide long-term shareholder value. So we do that. And similar to the way Ben spoke about how they go about investing, I think all 3 companies do the same thing. We run a 10-year unlevered financial model, and we look for targeted risk-adjusted returns. And of course, those returns that we would expect to get differ by country because some of the nuances country by country play into that analysis. So in more developed markets, like in the US and in Germany where we have assets, we're comfortable with a high single-digit return, maybe 10% return. When you go into kind of that next phase, those rapidly evolving wireless markets, places like India and throughout Latin America, a mid-teens return works for us. So we look for good opportunities in that range. And we also have investments in Africa. We're in 3 different countries in Africa. So if you look at the emerging markets, which I would call, let's say, Ghana and Uganda, which we're in both of those countries, we would look for much higher risk-adjusted returns. So in the high teens, maybe even 20% to get into those markets. So we're comfortable investing in all these different countries, and we seek to get the right risk-adjusted target return. And we do think that that'll provide our shareholders a long-term benefit. And these international markets, as Brenden suggested, they'll go through different phases of network development. The advanced markets are at one stage, the evolving markets are at another stage where they're going from finishing off 3G deployments, and we'll be heading into 4G deployments. And then the emerging markets, India is in this way in some of their regions, where they're building out their networks for the first time. They're building out voice networks for the first time, and in many places that will be done even before any landline networks get built. So in Ghana and some parts of India are certainly like that. So we think by having the right targeted investments internationally, that'll help us elongate our growth curve over time. As the US begins to slow, which it will, and I think Brenden alluded to that, we'll have 12 additional markets that'll be at different stages that'll help us continue to grow our business. And we traditionally see 300 to 400 basis points higher in growth from our international markets than we do in the US. We've been at the international investment now for 4 or 5 years, and our international investments are meeting our expectation, and the growth is there. So in the first quarter of 2014, our domestic business grew just over 9% core organic growth, and the international markets collectively grew at about 14%. So it's doing what it's meant to be doing, and we're comfortable, with our international investments. The last thing I would say on the international investing is we have a very disciplined approach in terms of which countries we would actually enter. So we certainly look for countries that have a real estate rule of law, where they uphold property rights, kind of the European style of law, and the countries that we've selected have that. We also look for a high-quality anchor tenant to go into these countries with. So the likes of an MTN in Africa, or a Vodafone, or a Tigo, Airtel over in India. So these are high-quality counterparties, and they are national wireless carriers themselves, or international wireless carriers, multinationals, so to speak. And then we certainly look for the quality of assets that we get, as well as an environment of co-location within those markets. We want to see multiple wireless carriers in the markets. We want to see the wireless carriers and the siting rules such that it facilitates co-location on neutrally hosted towers. So we've been able to find that in the 12 countries in addition to the US that we're investing in. So again, for us, it's about elongating that growth curve, well beyond a slowdown in the US at some point.
Thanks, Evan. One last issue maybe before we turn it over to the audience for just a couple of questions we have time for. An issue, as I said, near and dear to my heart is training, workforce issues. You heard the chairman of the FCC talk about how important it is working with Warriors for Wireless to train veterans, and we're looking at developing comprehensive training programs for not only veterans but others to be able to fill these open jobs in our industry. How serious do you see the labor shortage being, both in terms of tower crews and small cell and DAS installation, and what do you think we can do to help improve safety in the workplace through improved training programs?
We do see a labor shortage in our industry, and it's at one level a high-class problem to have because of unemployment in the United States. So that's attracting a lot of folks getting into our industry. We're very happy to be sponsors and supporters of Warriors for Wireless, and anticipate recruiting out of that, and have already started in that regard. In terms of safety, I think this is a very significant issue for the industry, and it's one that really goes to training. Unfortunately, there have been accidents and fatalities, and they seem to continue with tower climbing and the inherent danger that presents. And certainly, we as the Crown, probably shared by my colleagues on the stage, are continuing to support additional efforts around training. We have participated with at the federal level with instituting training standards. We certainly require that of our contractors as they come on site, but I think redoubling those efforts around training and making it a very, very serious undertaking for everyone who's on our site is a very, very significant issue for us and something we're taking very seriously.
Yeah, I would agree with that. There's really nothing that's more critical, I think, at this stage when you think about what it means. We've at SBA have tried to have made it a very focused objective of the company to increase and improve upon the training that's done, the safety training for new and inexperienced employees. We've actually developed a training facility in Birmingham, Alabama, where we have a training tower there. We train folks on tower rescues, on OSHA compliance, how to properly climb a tower. So we're trying to continue to expand the ways that we deal with safety issues within the industry, and I think it is an industry shift in focus that needs to take place, where the culture changes and safety becomes the predominant goal of all of us as an industry and all of you, because the last thing any of us wants to see is another fatality at one of our sites, particularly one that's preventable because somebody didn't know how to properly climb a tower. So it's something that we commend PCIA for all the things that you guys are doing, and as well the Warriors for Wireless training, with which we're participating in as well. I think the more steps like that we take, the better we will be, certainly as a group.
Yeah, I couldn't agree more. This industry is inherently dangerous. Lives have been lost deploying these networks, and with the volume increases, safety and training is even more important today than it ever has been. So for us, and I know for the other companies in the industry, safety is the priority. That comes before everything.
Thanks. We have time for just a couple of questions from the audience before we hear from our next keynote speaker from Ericsson. Trying to see if there's any microphones out there. Right there. Yes. We do have mics out in the audience.
Hello, Jonathan Schulkraut from Evercore. I was wondering if we could talk a little bit about where we are in terms of new cell sites applications versus amendment activity, and as you discuss that relative to your own tower portfolios, maybe give some perspective on why those numbers might vary from provider to provider. Thank you.
I think I understand your question. And it goes sometimes to nomenclature around how the three of us speak about things on earnings calls, I suspect. On our last earnings call, we mentioned that on a revenue basis, we were seeing in our sort of outlook for this year, so forward outlook for 2014, about 90% by revenue, new activity resulting from co-locations versus about 10% by revenue from amendments. And that is a material shift over the last couple of years, where we've now seen co-locations return to the market in a big way. We've further said about 10% of our revenue activity is made up from pre-sold commitments, where a carrier would have purchased a bundle of rights from us to do subsequent amendments on a site, so we wouldn't see incremental revenue, which would be necessarily then left out of that 90-10 discussion. So on a revenue basis, that's how we've described it. Those numbers are materially different if you talk about application activity, because obviously an application for an amendment would come at a fraction of a new co-location value. So sometimes it's nomenclature, and maybe those of us in the industry sometimes, I know I do, guilty of shifting between application activity versus revenue implications. Maybe we get a little too quick on our feet there sometimes, but in our case, that's basically what we're seeing. And so on an apples-to-apples basis, it's probably something like 80-20 in our forward outlook in terms of revenue contribution from new co-locations versus amendments.
Well, we are actually seeing we're seeing amendment activity continue at similar levels to what it's been in the past. We did see a shift in the middle of last year to where we started to have a little bit more of a contribution from leases relative to amendments. But if we look at our most recent completed quarter, the first quarter, we actually did sign up about 70% of the new business in terms of revenue that we signed up was actually from amendments. What I think has happened is the amendment activity, at least within SBA, and I would think it would be the same at others, has stayed relatively consistent, which is at a very high level. We have seen a pickup, though, in the number of new co-locations and new leases that are being signed by carriers, and so it started to move that mix a little bit down in terms of the amount coming from amendments versus new leases. But based on our backlogs, we still have a significant number of new amendments as well as new leases in our backlog. I mean, I guess the overall theme is that it's up across the board. New leases are certainly much higher than they've been in the past, and I think it goes to what Ben's saying. We're starting to see the carriers come back now and have to do a lot more infill and even still some coverage builds. And so, I think the cycle, as we mentioned earlier in the discussion, will continue for an extended period of time on both fronts, both amendments and new leases.
Yeah, in American Tower, we're also seeing that shift from co-location, from a higher concentration of amendment activity and a lower concentration of co-location. We're seeing that balance sort of shift. So at the end of 2013, that was at about a 75-25% mix for us. 75% of our activity was amendment activity, 25% was new co-locations. In Q1 of 2014, we have seen that shift, and in Q1 it was about 55%, 45%, and in our pipeline, it shows that it should continue in that direction. So we have seen a noticeable shift towards new co-location. Not only are we seeing it with the applications on our towers, but we're also seeing that with build-to-suit. So our build-to-suit counts are rising. Last year we built about 300 towers or so for the carriers, and this year we're thinking we can build 400 to 500 towers. So we definitely see the carriers, after they get through that initial LTE network upgrade, they then begin to shift their focus on new co-locations. That is definitely happening, and we see that in two ways: new co-locations on our existing towers and access to more new build-to-suits.
Great, well, we have time for one more. Right there, yes.
Jonathan, Sharp Smith with AGL Media Group. I was wondering if you all would give me some of your analysis on the AT&T's purchase of DirecTV and its impact on the tower industry.
I'll be perfectly honest, and I'll start. I don't think it has a lot of impact on our business initially. I certainly don't have any insight beyond what I've read in the press, but AT&T is still very committed, as all of the carriers are, to making incrementally profitable investments in network capacity, which all four carriers are actually demonstrating today. A point we haven't made in this session this morning. It's very important as we look at a market, particularly the U.S. market, to see the carriers be able to invest $1 in their network capacity, network CapEx, and get $1 of ARPU out of it. And if you notice, all four carriers are able to do that in the United States today. And I don't see that changing for the foreseeable future. So AT&T has made a strategic decision to move into the satellite TV business and augment that, which could ultimately become an additional wireless product, where you may see more multicasting across the wireless networks. Longer term, we'll see where their plans ultimately take them with that. But near-term impacts for us, I think, are minimal. And to the extent they're ultimately going to use these wireless networks to put more content through, that's certainly positive.
I agree. How's that? For succinct.
Yeah, it's unanimous. I agree as well. There's nothing new to add to that.
Well, great. We're going to hear in a minute from our next keynote speaker, Avish Nanlal from Ericsson. But in the meantime, let's give a big thanks to our executive panelists. Thank you very much.